500 banks are about to fail due to commercial real estate. Section 1. The silent shift in American cities. The workday used to fill downtown areas with people, but now many offices are nearly empty. This change is not temporary. It is a major shift caused by technology and remote work. When offices stay half full, buildings lose rental income, and their business model begins to fail. When this weakens a whole city at once, the financial system feels it too. Section 2. The debt wall arriving now. About $1.5 trillion in commercial real estate loans must be repaid or refinanced within 2 years. These loans were created when interest rates were near zero and buildings were full. Today, interest rates are high and offices are partly empty, making many buildings worth less than the loans tied to them. Many owners cannot refinance or repay, creating thousands of zombie buildings. Section 3. How falling values destroy banks. Commercial buildings are valued by income and something called a cap rate. When interest rates rise, required cap rates rise too, cutting building values sharply. A building once valued at $100 million may now be worth only $50 million. If the loan is $60 million, the owner's equity disappears and the loan becomes underwater. When enough owners walk away, the banks holding these loans face major losses. Section 4. The extend and pretend tactic. Instead of admitting these losses, banks and regulators delay them. They extend loans and pretend the borrowers will recover. This avoids reporting large write-downs, but it does not fix the problem. This delay only works if occupancy or interest rates improve. Both trends remain weak, meaning many banks are hiding deep losses that cannot stay hidden forever. Section 5. Why regional banks are most at risk. Large banks reduced risky lending after the 2008 crisis. Regional banks moved in and now hold about 70% of all commercial real estate loans. In some cases, these loans equal several times the bank's total capital. A drop of only 20% in property values can wipe out a bank completely. Property values have dropped 40% to 50% in many cities. Research shows hundreds of banks may be technically insolvent if loans were valued at today's market levels. Section 6. The urban doom loop. City budgets depend heavily on commercial property taxes. When building values fall, tax revenue drops. Cities respond by cutting services or raising taxes. Reduced services and higher taxes drive people and businesses away, shrinking the tax base even more. This feedback loop, called the urban doom loop, leads to weaker city centers and declining local economies. Section 7. What happens next? Many loans will soon reach maturity. When borrowers cannot pay even interest, banks must face losses. This may trigger failures at regional banks. The FDIC will intervene, but its fund cannot fully cover all deposits. This risk makes personal bank safety important. Section 8. Practical protection steps. Keep deposits under the $250,000 FDIC limit at each bank. Consider moving savings to larger global banks or short-term treasury bills. Wait for later opportunities in real estate, not during the fall. Protect long-term buying power with assets that cannot be printed, such as metals or digital hardcap assets. Section 9. Final insight. Many buildings no longer have enough tenants to support their debt. When building values collapse, bank capital disappears. When bank capital disappears, bank stability collapses. Awareness and early action are the best tools to avoid being caught in this slow-moving crisis.